Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Yes, I am so excited today to introduce our guest. It's Todd Langford. Tell you a little bit about him. Todd is the founder and creator of Truth Concepts Financial Calculators. And we're going to talk about that. It's really cool. I use it myself. His love for numbers and desire for integrity in the financial space inspired him to create calculators that would cut the pretense and get straight to the truth. And that is as about a straightforward a statement as can be said about what he does. There's no bones about it. He's going to tell you exactly. He does not let the math be twisted in any way. So anyway, this technical, straightforward, and earnest thinking sets the tone for much of Todd's work. Driven by a desire to understand how all things function, Todd continues to up-level the calculators as well as his own personal technology, evidenced through his personal solar panel network and other things. I know he and his wife raise alpacas, and they use stuff with the hair. They do all kinds of stuff. They're always learning. That's one of the things that inspires me about Todd. He is a constant learner, and I love those kinds of people, and I want those kinds of people in my life. I appreciate it. So welcome to the podcast, Todd.
Thanks for having me. I really appreciate your desire to always talk about the truth as well. And so that's something that, we don't see all the time in our industry, and some of it by accident, some of it maybe on purpose, right?
Right. And we were talking before the show started that you said to get into the financial space and what you're doing was an accident, so to speak. Tell me a little bit how that happened.
Yeah, well, so I don't know that a lot of people got into this area on purpose. Some did probably, but I think when they're going around and you're younger and they're saying, "What do you want to be when you grow up?" I don't know that financial analyst is on the list with fireman, policeman, doctor, lawyer, all those other things. But for me, I really had no idea. And while I was going to school, I got connected. I actually kind of got connected with computers. That was right when the IBM PC first came out, and so there was a place that I hired on to just to work on them because I found that I could kind of repair them and write some small batch files and things at the time. And one of their big clients was a big estate planner for the time, and so I spent quite a bit of time at their office moving computers around and doing different things. And Lotus was the spreadsheet of the day, and so I started helping edit some of the Lotus spreadsheets for the estate planning side. And so I started kind of creating some of these for them, and really just fell in love with the industry, and from there graduated really into where I am. So from a field of biology, totally different than where I ended up with, I found an industry that, I really have a heart for.
And it's all about math. So was there a lot of math in biology as well? And you obviously love math.
Well, yeah. So, financial math is a different level too. We can look at grade school math and even college math. Most of it's pretty linear. Financial math takes on a whole different thing because it has the element of time. And so that's a whole different dimension that you can't use straight linear math for. And so, it was a little challenging in the early career looking at those pieces, but it was really intriguing too because it was so different. And so, yeah, there's some math there. The main thing is for me, the way I look at the pieces and parts is I go at it one direction. And something I learned in math class was, okay, now rearrange those numbers and see if they still come out. Right? So prove it another different direction and see if everything says the same thing. And so that's where I got to on the math side. So without having a lot of math background, I always loved algebra and trig and geometry and all the pieces. And so I think all that kind of came together. And with the computer to do the hard work, it was a perfect place for me.
We'll talk a little more about financial math. There's a lot of financial planners and different things that are selling or recommending products that they'll say, okay, give me this amount of money every month, and in 35 years, you'll have this. Right? It's just that's almost a linear thing, right? It's a boom, boom. But tell us a little bit more about that and why that's flawed thinking.
Well, the reason for it is, so in that scenario, without a financial calculator, you really can't calculate that of some kind, because when you compound money, the previous amount compounds into the next amount, into the next amount, into the next amount, and the next amount. So how do you do that linearly? Yeah, you could write down each year and keep going through, and then you could see where you are. But what I think a lot of people try to do is add up math over time. And when you just add math over time, you leave out the compound cost of money. That same thing that creates that exponential curve in math. So, with math, that example that you gave, it doesn't grow like this, it grows like this, right? And most of that growth happens on the back end. Well, why does it happen on the back end? It's because it's been able to take advantage of all those incremental increases along the way, and they just get bigger and bigger, and most of it happens in those latter years. And that's the reason, often times when we talk about when to start saving, those kind of things, well, the earlier we do that, the better, because that big growth happens at the far end. So the longer time we have, the more we're gonna see that exponential increase. And so, there's pieces and parts that add to that misinformation. So, for example, most people would say, well, 5% is more than 3%. And what I would say is, well, 5 is more than 3. But 5% may not be more than 3% because it requires another piece. 5% of $10,000 is less than 3% of $100,000. Right? So there's part of the formula, part of the pieces that are left out. So when we say, well, 3 taken away from 5 is 2, yes, but 3% from 5% may not be 2%. And it depends on time, and it depends on the amount of money that we're talking about that's a percentage of. And so there's other pieces in there that take it away from linear math, and yet most people try to use linear math to explain financial math calculations, and they do it over time. And so the results are just wrong. It's not that the math is wrong. 5% minus 3% is 2% if you just did the math, but that's not going to be the result that's going to happen, right? So the formula is wrong, even though the math is right, if that makes sense.
Correct. And so one of the things you've taught me that say, okay, one person's getting 3% and one person's getting 5%. Oh, well, I can get 2% more with the 5%. When the reality is that's 66% more, right?
Right.
Percentage point. It's a lot bigger than what you actually think.
Yep.
And that's another example of, using linear math. I guess that's the right thing, or a non-financial math. And you're not really taking all the different parameters into consideration. And that's one thing that Truth Concepts does, is it takes, as far as I can tell, everything into consideration, right? All the little nuances like that have been worked out, have been thought about for long periods of time by yourself and even your mentor, saying that that's not right. This is really as close as we can get to reality. And on this podcast, we've talked a little bit about the infinite banking concept, and we've talked a little bit about whole life, and how the reality is it's one of the best financial instruments there is. And I say that with confidence for the fact I have learned so much from you. You put on a 2 or 3 day training, whether it's in Houston or Salt Lake or different places, and I've been there and sat through it. I think I'm close to 10 times, right?
Yeah.
And I'm still getting it. Talk a little bit about what your feelings are about whole life and why that needs to be in everybody's portfolio.
Sure. Well, and I'm going to start with what you said about, going multiple times. You know how when you read something, sometimes and take the Bible as an example, you read something and it says one thing when you read it, and you read it again, it's like, holy cow, I completely missed this, because things have changed where you have a better understanding of what's going on, and it just gets bigger and bigger. And that still happens for me. I will dig in and look at the way a life insurance policy works, some of the pieces and parts that it does, and that allows me to get to another level and see how much bigger even that is over time, how many more places that fits, more things that it can do. But it is just a tool. And so we need to be careful there. It's how it fits into the strategy. And one thing about life insurance is it makes every other investment better, right? So it just enhances everything else that we do, both during the accumulation phase and actually during the distribution phase. And it's funny because a lot of people, kind of from a selfish standpoint, I think, they look at the death benefit as not the important part of a life insurance policy. It is a life insurance policy. That is a critical piece. And boy, when we get to the distribution phase, the difference it's going to make in our ability to spend our assets is phenomenal. It will actually make all of our assets way better, having that death benefit actually in place during that distribution phase. So it works beautifully during the accumulation phase. What I like to call the cash value during the accumulation is that emergency opportunity fund. And I think both of those pieces are so important. It's not really an investment. I don't like life insurance, in that category because it's really a savings vehicle. It acts more like that. It's a safe liquid asset. And so what it does for us and the growth of all of our assets is it takes some of the risk away from those other things. So one of the things, black swan events are going to occur, right? We can mark everything down on paper. We can do the estimates. We can look at what happens when all this works out in the future, and we can have all that written down on our uncertain assets. But there are still things that get in there and get in the way. Take real estate, for example. We can look at it and see how all the returns are. Everything looks great. And then a hurricane can come through and take a roof off that we didn't plan. Or we could have 9/11 and all of a sudden we've got vacancies. Or, everybody always says whenever we have one of those big events, gosh, everything would have worked great. We just had no idea that this was going to happen. Well, the truth of the matter is we had an idea something was going to happen. We didn't know it was going to be that necessarily, but something was going to happen, right? And so we have to have those certain assets like life insurance, cash value to get us through those humps. So anybody who had to sell that real estate during those times ended up losing everything. But people that had access to cash were able to actually get through that, maybe even buy some stuff and enhance their portfolio over time. So not everybody lost in those scenarios. The ones that were prepared and had certain assets to protect those uncertain assets, that it made it work out. One of the things that I like to talk about is, because everybody likes uncertainty, right? I mean,
yeah.
Here's the thing. It's part of life. We talk about certainty, and that's a cool thing. And with life insurance, we have certainty, but it's boring, right? And people like spice. And so we have to have uncertainty in our life to have that spice of life. And, one of the ways we can look at it is whether you like roller coasters or not, it's that thrill on the edge, but you still put your seatbelt on. Right? So you like that certainty of that other piece. And that's really what life insurance gives us during that accumulation phase. That cash value that's that certainty piece. That's that seat belt that turns really the uncertain assets into opportunity rather than gambling. Uncertainty without certainty is gambling. You might get lucky. You might be the one that it just worked out on. And we've seen that happen for people. But if we take a long period of time, it's pretty unlikely without our certainty assets. So when we look at life insurance, it becomes that buffer. It becomes that tool that gets us through the emergencies. But the other side of that is the opportunity. When you're in a position of cash, you can take advantage of those once-in-a-lifetime deals that come along. And so it helps on both sides. And we need all of that, to have a full, holistic financial life, I think.
You have used the term life insurance several times, and I don't know what your feelings are. I think it's to some degree a misnomer, and I actually make, when I'm talking to people, I kind of make a distinction so that people understand that real life insurance is going to be around when death does occur. There's no chance that it's going to be termed out or it's going to cannibalize and collapse or whatever. So I quite often will refer to term insurance as death insurance for the fact that someone's got to die in order for a benefit to happen.
Right.
Right. And However, the industry would never want to sell death insurance. No one wants to talk about death insurance, right? But when you look at it, that's kind of what it is. Okay, you're covered, you're renting a death benefit for a certain period of time, then it's over with. You said life insurance, and I'm going to use whole life insurance, is important. The death benefit is important because it allows your other assets to be better. Well, in the event that there's a possibility of that death benefit not being in existence at that time, then it's not doing any good. There isn't certainty there.
That's exactly right.
I don't want to get into a bashing session here, but tell us a few things why you believe that IULs or EIULs really don't give you that foundation that you were talking about when you use the term life insurance.
Sure. Well, there's a couple of pieces there. So with whole life, we've got all kinds of guarantees. We've got a guaranteed premium amount that if this premium amount is paid, it's guaranteed to pay out a death benefit when we die. And so if you look out and you think about this, so if you knew that you were going to win the lottery at some point out there in the future, that this amount of money was going to dump into your estate, would that change how you spent money today? And I say, yes, if you can count on that happening, it changes your strategies that are available today on how you spend your money, because you know that's going to come in at some point in time. And with whole life insurance, we can leverage that fact that X amount of money is going to dump in at some point in time because it's guaranteed to happen. So it changes the strategies that are afforded me during my life. So it's going to impact me on how I can spend assets. And so I get to take advantage of some strategies under that are going to save tax and other pieces along the way, knowing that that's going to end up coming into my estate. Now, if I have a different type of life insurance, and you mentioned the universal life chassis, the guarantees are not there on those assets. I can't guarantee that I can afford whatever the premium is, because the premium's not guaranteed, to keep that in force. So I could outlive that. There's no guarantee that it'll pay out when I die. And if there's not that guarantee, can I really leverage the possibility that it might happen in the future? That's too dangerous. And so having that guarantee that it's going to happen in the future changes how I can spend my assets for myself. Whereas with universal life, I can't do that because there's some risk there. And I know some of the argument is, yes, but if you really watch that universal life really closely and put money in there and make sure it doesn't get out of whack, that it should be there at the end. They still can't really guarantee that it will be, but it should be. To me, that totally undermines the point of the certainty, right? You're using a certainty asset to cover the uncertain assets, and now you've taken the certain asset and exposed it to a maybe. For me, I would never do that for myself, and if I would never do it for myself, I would never do it for a client.
Well, let's be clear there. I don't believe you're actually life insurance licensed, are you? Do you actually do life insurance?
I am life insurance licensed, but I really don't see clients anymore. Right. Software is
the whole thing, right? So there's not really, yeah. And what you said a minute ago about the universal life and whole life, all this is based on, I don't know if you want to call it your research or your experience in squeezing, the contract and squeezing the numbers and how it really, really works. I mean, listeners, I'm serious. You can go to as much detail as you want with Todd and his calculators, and it works out when you're doing it with whole life. The other way, it doesn't. It's just, you run into roadblocks, you run into landmines, you run into problems.
Yeah. I can't say that it won't work out, but at the same time, I can't say that it will. And that's where the problem is. It might. We might get lucky. We might not have a black swan event. We might, might, but I don't have to worry about that with the whole life insurance because it will. It's guaranteed to. And so it's going to perform. And so I would much rather be on it will happen rather than it might happen. And so I know you've heard this before, Jason, because I use it a lot. My mentor, Norman Baker, one of the things that he told me early on was there are no deals in the insurance business. And that's true whether it's regular property and casualty insurance, house insurance, homeowners insurance, and whether it's life insurance. Everything is a trade-off for the insurance company between risk and cost, right? It has to be. That's why term insurance is so cheap, right? Term insurance is, it's not really cheap. It's inexpensive. I don't know. If we don't get anything for it, then we had a cost for nothing, right? But we really don't want to get anything because it means we have to die early. But forgetting that, it's very inexpensive because there's very little risk for the insurance company that they're going to pay out during the time somebody's covered that's healthy enough to get the insurance. Whole life insurance has a higher premium because it's guaranteed to pay out at the end. Universal life is priced properly. Whole life insurance is priced properly. So if universal life is a lot less expensive or has a lower premium than whole life and it's priced properly, then the only way that can happen is there's less risk for the insurance company on a payout, right? And so really that's the way it comes around. It's not that it's a bad product, it's not that it's not priced right, but I want something that's going to be there at the end. So I would rather pay the higher premium.
I love that we interviewed a guy who Kelly Korshak, and you can go back and listen to that, but he at one point ran the risk desk for Deutsche Bank, right? And he was overseeing billions of dollars, and he was the different fund managers, and he's all about risk and what, hedge funds and all these huge money is they're looking for a way to transfer risk away from themselves, right? To have someone else take that risk so that their money and what they do is secure, right? And what you're saying right here is the exact same thing. With whole life, we are truly able to transfer the risk of collapse or the risk of it not happening away from us, where with universal and term, all the risk comes back to us. And it seems like to me, it's completely defeating the purpose. Because I believe the very first beneficiary of a life insurance, and I'm saying that life insurance policy should be the individual that owns the policy. They should be the first beneficiary, right? And that's all about what you're talking about, which I love it. So we've used the word guarantee a couple times. Todd, there's nothing guaranteed. Right. We could have a nuclear holocaust tomorrow and it's all done. Right. Why do you feel so comfortable in saying that whole life insurance is guaranteed? Because I've heard you say in the event there was a nuclear holocaust, that the next day the only thing would be left would be cockroaches and life insurance companies. Yet, okay, you're not saying that. It's funny. Yet you're not saying that just to be funny. There's some underlying grounding there from the math and your experience of what you've done that you feel comfortable in saying that with a straight face.
Yeah. Well, and yes, a little humor there, obviously. I think Twinkies was also in that mix. So.
Oh, yeah, I think it was.
But they don't exist anymore, I guess. But unless you can find an old one, you might find one 50 years old is still good, probably. So I don't know. But no, the thing about it is we've seen what happens over time, and we've seen the fact that they have the reserves and the other pieces that they have to have, which is a pure cost for what the insurance company does for them to hold those reserves, but that guarantees that they're going to be able to pay it out. And the result is we have seen major black swan events, from world wars to complete stock market crashes to everything else. And the life insurance industry has survived through all that. Whole life insurance has survived through all that, 200 plus years. There's not a lot of things that fit in that category, right? Like anything. And when we look at the guarantees from the insurance company, yeah, could something happen and we have a total meltdown of everything and the dollar is no good anymore? All right, sure. And there wasn't anything anyway. And so that's not something that we need to be concerned about. If everything is under normal situations, life insurance is going to be there under whatever comes at us. If anything else is surviving, then life insurance is going to be there. That's where really all the money is. If you look at it like big real estate deals, those kind of things, most of the time the money comes from an insurance company versus from banks and other pieces, because that is where the money is.
Okay, so I'm going to jump in right there, and from personal experience, Carter and Scott and I had worked on a project in Texas. We were attempting to reposition $1.3 billion portfolio for a man. Okay. And you're exactly right. It wasn't banks like Wells Fargo, et cetera, using a name here. We were starting to talk to large insurance companies to help with that project. So just backing up what you're saying there, Todd. Sorry to interrupt you. Keep going.
Yeah. No, that's great, because that's what's important. And yet, the other side, some people would look at that statement that you just made and say, "Oh, that's because insurance companies, they have everybody's money." But if we're talking about the mutual life insurance companies, we want them to have the money, because as a policyholder with that company, I'm one of the owners. I get to share in all the profits of the company. We want them to be profitable, right? And that money all comes back by law. In order to stay mutual, they have to disperse those profits to the policyholders, because they are owners of the company at some level, right?
Yeah, if you use the example, people know that there's preferred stock and then common stock. And I tell them, say, look, I've got an in, and I have the ability to purchase as much preferred stock of Apple as you want to get. How much do you want to get? And they're always real quick to say, oh, I want as much, I'll put everything into that. And the reality is, a more stable, longer longevity, and possibly even more profitable company is a mutual life insurance company. And they have the opportunity to buy as much of that company as they want, right? It's the exact same thing. Yet people don't understand that. Why is it that people don't understand as much about whole life, and why does it have such a stigma, at least in a certain generation? I think Carter's generation, the Scott's generation, the sort of millennials, they're all over it. When I talk to them, they get it so much quicker than, say, the baby boomers and the Generation Xers. Why do you think that's the case?
So what I will say is, life insurance industry does not have a great reputation. And the life insurance industry has earned that reputation, right? And where that's come from is some of the stuff out there that people thought was something different than what they bought. Okay. And that's one of the issues in my mind with universal life. Is we had universal life that came out, in the 80s, and a lot of it was, we saw really high interest rates. People were doing minimally funding, but all they heard at the time was life insurance. And when you think about insurance, what does insure mean? To most people, it means to guarantee something's going to happen, right? That's going to be there when that happens. And that's a real misnomer when we talk about universal life, because it's not guaranteed to be there. It's guaranteed to be there under the right circumstances, but if those circumstances shift, it might not be there. And we had very high interest rates, so people were making minimum premium payments, because you can do that with universal life. And the result is that when those things failed and came apart, they came apart when people needed them. And it tainted the industry, right? And even though the whole industry wasn't that's what hit the news. That's what people heard. That's what people thought. And so the immediate reaction is, wait, those insurance companies failed to pay. They ripped people off, all these things. But remember what I said earlier, and that is, it's priced correctly for the risk that the insurance company is exposed for. The problem is, nobody told the insured, the people buying the insurance, that they were taking on a piece of that risk. The reason it was cheaper for them to buy universal life than whole life was because they were taking on some of that risk. And when those things fell apart, that was the risk they were taking on. Well, they don't remember, even if they were told that, which I'm sure they weren't, there's no way they're going to remember that 30 years later from when they bought it. And so what happens in desperation, and I've heard those calls because my wife, Kim, has a big presence around life insurance, and people will call from the hospital, literally saying, my husband is in the hospital. I don't think he's going to make it out of there. I just got a premium notice from my insurance company that's 20 times what we've been paying. There's no way I can afford that. Can they really take this away from us? I mean, that level of, I do not like those conversations. And even though it wasn't anything that we sold, you feel for these people because yes, the only answer is yes, they can do that. That policy will lapse if you can't come up with a premium. And so they're right here literally at the deathbed, and that policy may not pay out depending on what the circumstances or how long that individual lives. That is not a place I want to be. And if it's not a place I want to be, I certainly don't want my clients or anybody I know to be there either. Yes, they were able to pay a smaller premium. The result is it may not be there. Now, who gets blamed for that? The insurance industry, right? The whole industry, not just universal life, whole life, everything gets lumped into the same thing as just being life insurance industry has caused this. So that's why I say the insurance industry got a reputation they deserve at some level because they allowed those products to exist without explaining what it is. And I don't think there's a problem with them allowing or creating those products. It's just the public needs to know when they buy them how much of that risk they're taking on for themselves. And if they're okay doing that, that's a whole different story. But I think a lot of people did it without knowing what they were getting into. You know, some of the times I remember, this is universal life is whole life insurance for half the price. Well, it can't be the same thing as if it's half the price. It just doesn't work like that, right?
Yeah, we could go on and on. Like I said, I don't want to come into a bash, session here of one versus the other. Yet I have that discussion all the time. And truthconcepts.com is Todd's website, and he does have a blog. And yours truly has contributed a couple of times, a long time ago, to that blog. There's some great articles there, and you can go to that blog, and I recommend everybody go there. You can just go into the search bar, you search UL, and there's 3 or 4 articles that come up that are very, very well written to help you understand some of the nuances, and it's kind of in bullet point form. But that there's tons of information there that Todd and his team puts out for people to understand some of the misnomers, some of the misinformation, whether that's intentional or not, in the financial industry, which is really cool. And that's one way that everyone could, benefit from this podcast, is just going to truthconcepts.com and taking a look at the blog. I also think, isn't there a way that they can take a test drive of the Truth Concept software?
Yeah, they can. So anybody can download it, install it, and it'll run for 30 days. So yeah, if you want to play with it, you're welcome to do that. It'd be interesting for somebody without a financial background, but if they've got some info that they wanted to, say, hey, is this true? I mean, they could feed it in there and do what they want to do with it for at least for 30 days. So fun place to look at it. If you love the numbers, then that's definitely a place to go. I like the numbers because they help let me tell a story around what's going on and know that what I'm talking about is the truth. And I'm one of those people, I can't sell something if I don't absolutely know it's right all the way through. And so I have taken the numbers all the way down to abacus level just to make sure that everything is there. And once I see that, then I can step away from the numbers and understand the concepts or the strategies from a big picture point of view, because the numbers aren't everything we do. But if the numbers aren't right, then the concept's not right either. So both of them really have to be right.
In alignment. Let's talk a little bit backtrack a little bit. You talked about how in passive income time, we're avoiding the whole retirement. I don't like to say that, but the passive income time of life. You said that a certain asset, like a properly designed whole life policy, makes all the other investments better. Why is that? And explain that a little bit to us.
Well, there's a bunch of different pieces and parts, and I'll throw just a couple out. So as an example, if I know that lump sum is coming back into my estate at some point in time, the whole life insurance, if I know for sure it's coming back in, then I can look at some of my other assets. And rather than just spending interest only off the assets, which is where most people are forced to be because they don't know how long they're going to live, they don't know how long the money's going to last, they're forced in that position of taking just interest only. And so they're paying taxes on that every single year. Whereas if we could do a pay down on that asset, spending both principal and interest over time, then there's 2 things that happen. One, we actually get to spend the money that we put there instead of letting the financial institutions take advantage of the big bulk of it the whole time. And it creates some tax strategy around the point that our taxes are actually going to be less and less and less and less each year as we consume that asset, knowing that the life insurance is there. So we can end up spending more money with less assets. And quite honestly, what's more important during the distribution phase, especially, or that passive income stage, is it net worth or is it cash flow?
It's a
cash flow, right?
Lifestyle, right? They want to have
right.
a lifestyle, and they don't want to have the huge fear of, I'm going to have more life than money, right? I'm going to run out of money before I die. But keep
right. Yeah, so that's one example of where a strategy might fit in there. Another one, reverse mortgage. That's a super opportunity to take a non-income producing asset and turn it into an income producer. The problem is most people won't do that because that's that last asset that they want to pass to the kids or to the next generation in that legacy piece. So most people won't pull the trigger and do that reverse mortgage because the bank, in all likelihood, is going to end up with that house because of the amount of debt that's pulled off of it. Well, if we have a life insurance policy in place, not to put in place at that point in time, but one that we already had in place, then now that reverse mortgage strategy becomes huge, because what it allows us to do is to take that reverse mortgage and spin the house down. We might even exceed the value of the house. It's certainly possible with tax-free income. And then at death, the heirs are in the driving position. Most of the time, the kids don't want the house. They might be in another state. The house is going to cause them a problem from the standpoint of an estate tax, trying to get rid of it, all these other things. But if the kids have the life insurance policy and they really wanted the house, they could buy it back from the bank. Or they could let the bank have it and spend the life insurance. So now that reverse mortgage strategy, because of the presence of life insurance, becomes a huge, huge opportunity from an income standpoint for something that otherwise was not an income producer. And again, without life insurance, it's hard for people to pull the trigger on that. And with life insurance, it becomes possible. Another big one, the last one that I'll talk about, is the charitable remainder trust. That could also be huge. So for greatly appreciated assets, let's say somebody has a huge real estate portfolio, right? They may have been rolling that from property to property to property along the way. They may have no actual depreciation basis anymore. It may have been all used up. So if they were to sell that property, they would get dinged with a ton of capital gains tax and a ton of depreciation recapture tax. It might even, I've seen people where they're in a position where if they sold a property, they would owe more in tax than they got out of the property because of all the previous properties that got rolled into that one. And so now they're stuck with this property that they can't really sell. A charitable remainder trust allows them to sell that or actually gift that to a charity. And in that gifting, there's no capital gains tax, no depreciation recapture tax that has to happen. So the whole property gets gifted and the individual can retain the income as long as they're alive off of that amount of money. And at death, yes, the charity is going to get the whole asset that wouldn't go to the heirs, but the kids will get the life insurance that replace that. So now that it unlocks another huge potential tool, and it allows people to be more charitable, right, in the process. So not only do you get to be charitable, you get a tax deduction for making the contribution, you get tax-free income potentially, depending on how that charitable remainder trust is set up, and the charity gets the benefit when you die, and you didn't disinherit anybody because of the life insurance.
Right. And that's all got to be happening. The sooner the better, right? The best time to have done it was 20 years ago, and the next best time is today.
That's exactly right.
It is something that us in this industry battle all the time, is that bad reputation. Yet when people understand that what you just went through right now, there's no one on the planet that wouldn't say, yeah, I've got to do this. However, they don't hear that for the fact the vast majority of financial what's the right term, planners or people in the financial industry do not have that kind of education that would come from spending some time with you in Truth Concepts. It's the bottom line. I mean, there's no way around that unless you have something else to tell me.
No, it's kind of interesting, and along with that reputation, I mean, really, when it's understood, whole life insurance is probably the competition for almost every other financial product out there. And all the rest of the industry knows who their competition is. And so they're constantly beating up the life insurance industry. They're constantly putting stuff out there about, poor rate of return and all these other things, which when you look at it, just flat isn't true. But the insurance industry hasn't figured that out. They think their competition a lot of times is another insurance company. And so there's a lot of infighting instead of realizing what a force they are, and that the real battle from a competition standpoint is all the other financial products that are out there.
I often tell people that the risk is in the investor, not the investment. And I also tell
them, that's critical.
Yeah, that's all their understanding. For someone to say, "Oh, your whole life is a terrible investment," and I say, "Yeah, you're right. And you don't understand it, right?" I used to have a man up the street that was a roofer. And I remember one day he came with his truck and he showed me this brand new pneumatic hammer that was like $700. That would be a terrible investment for Jason Henderson. I don't know how to use it. I can't put it to use, nothing. That was a perfect investment for him, so his guys could put on more shingles faster, right?
Oh, yeah.
I see that the same thing with whole life. When you truly understand it, it's not what's the minimum I need. It's what's the most I can get. It becomes more the discussion. Let's talk a little bit about the opportunity fund that you talked to. So, because cash value or whole life insurance has cash values, and that is a liquid cash accumulation pocket or account that allows you to go after all kinds of one-in-a-lifetime opportunities, or even decent opportunities. Can you give us a couple of stories of things that you heard of where people have been able to, quickly use the liquidity of their cash value? I'll tell you one just to share as you're thinking about it. So I have a client that, most financial clients, at least been my experience, they kind of ease into you as they get to trust you more. So they don't tell you everything, right? What they have. And so this particular guy, we're into the relationship about 3 years. He says, I'd really like to, I like these cash values. How can I put them to use? And I says, well, I started talking to him about things he can do. Well, it comes out that he's a part owner in 10 Taco Bells. And I said, wow. Oh yeah, is there mortgages, is there loans against those? And he says, oh yeah, we're paying, I think it was like 10%, right? I want to say, I don't know, it was maybe a 10-year amortization, but a 5-year balloon. I mean, it's fairly short, so his payments were fairly high. I said, well, do you think your partners would be good with maybe a 9% note at 10-year amortization with no balloon? He says, well, yeah, our payment would be less, because they're always thinking monthly cash flow. I said, well, you're sitting in the middle of an opportunity right now with your cash values. And we literally were able to fill out a 1-page form and did a $750,000 loan, and he had his money in his account in a week. That's liquidity, right? He didn't have to qualify for it. He refinanced these Taco Bells for his partners, made the Taco Bells on sure footing, right? Because they had less monthly payments. But all of a sudden, he's able to capture that money that was going to some other financial institution instead of he got it himself. Anyway, that's an example. Do you have a couple of examples where people have been able to use their opportunity fund, their cash values, to go after some great opportunities?
Sure. I mean, and so, think about this. Why does that opportunity of a lifetime usually come along?
Because you have it, right? You have the cash to do it.
Or looking at it, why the opportunity presents itself is because somebody doesn't have the cash. Usually that's where the problem is, right? Yes, it's because they need cash. And if they need the cash and they're desperate and they're making a deal on a piece of property or whatever else, the deal is not going to work if you say, well, let me check with my banker and in 2 months maybe I can get the money. The problem is on the deals, they need the cash and they need it now. And that's the beauty of the life insurance contract, is we can borrow that money and have it in a week or so, right? if we need to, most scenarios, we could have it overnighted. And so if it needs to be that quick, but that's what has to happen to make those deals of a lifetime come around. And I had a good friend just when some of the real estate dropped in Destin, in Florida, and he was approached. It's like this condo was less than half of what the market value was, even after the drop. And the guy said, I have to have cash in 2 weeks or my whole world comes apart. And for this friend of mine, he was able to borrow money from the insurance company. It was actually at a higher rate than what he could have gotten from the bank. But the bank would have taken 30, 60 days to get the money. So instantly he was able to borrow the money from the insurance company, make the deal happen, and then go back and refinance the deal and pay the loan off and have it at lower rates. So it gives that flexibility. Most of the time, the bank, the rate the insurance company is going to offer is going to be pretty common to what the bank's rates are, maybe even a little less depending on what's going on. But when it's not, it still is the only way some of those opportunities happen. So it's having access to cash that's the critical piece. And then we can still incorporate some other pieces in there in the mix, right?
You bet. Other examples?
Oh, I mean, I know of people that do leasing as well. So they use their cash values because they can borrow money at a lower rate than what they can use to set up a leasing company and those kind of pieces and parts. And so there's, it's kind of like how high is up. One of the statements that I really liked from Nelson Nash, and that was, when you're in a position of cash, opportunity will seek you out. Right? And so I think that's a critical piece. And if we understand how life insurance is and what works there, that cash is access to opportunity. I think it shifts what we're doing. I think, unfortunately, a lot of people get caught in this idea, well, it's sitting at the insurance company. It's not really my money. And it's absolutely your money. And the other thing is, when we look at borrowing against that money and taking a loan from the insurance company, well, it's not right. I have to borrow my money. Well, that's not really the way it works. We can liquidate the money from the policy, right? We can take a liquidation. The problem is, due to the IRS regulations, we can't put that money back and earn that great rate of return along with having the death benefit and other pieces. So if we choose to liquidate it out of there, getting it back in there becomes more difficult. If I borrow against it, then I can pay those loans back and it's all right back in there. Even though it's in there all along, it's just that the total value is back and we can get rid of the loan. So we never lose the earnings or anything else on those dollars if we borrow against it instead of liquidating.
And then let's be clear that to get money inside the contract is over time, right? It's not that we can stuff a whole bunch in there right away. I mean, there's some here and there that you can, but really the value is being able to stuff it in there over time and build that up. And so when you kill that tax advantage by liquidating it and not being able to put it back, you've shot yourself in the foot from a tax point of view and ongoing growth. Man, Todd, I could talk to you all day long and tomorrow and the next day, but you want to have a weekend? So I kind of wanted, this has been so awesome. Every time I talk to you and I'm around you, I learn so much, and it's really good. And I hope the listeners have really learned some things too, because there's been a lot of people on this podcast that are successful in real estate. They're investing in real estate, whether they're flipping or multifamily, all different sizes of portfolios and what they're doing. And the bottom line is, as you had said, that whole life insurance designed the right way and put in place will make everything else better. Every other investment you're involved in becomes better. And that's not being said simply as a marketing tagline. It's based on Todd's understanding of the money and thinking through this every which way till Saturday or whatever you want to say. I mean, every day.
Yeah.
So kind of two parting questions, Todd. One is, in the event you could go back and talk to your 18-year-old self, what kind of advice would you give them? And the second question is sort of a two-part. It's an invitation and it's a question. what is the next mountain to climb, or what's your next goal, big goal, and whether that's 3 years out or 5 years out, I don't care. And then an invitation to come back on the podcast when you've accomplished that goal.
Cool. Well, I guess, what would I tell my 18-year-old self? That, quite honestly, I didn't need school to dig into this, right? But no, I learned a ton from school and everything else. But at the same time, I drug my feet a little bit on how quickly I got into the industry and understood what was going on. And I would get in sooner. I would dig deeper. And I guess, you think about it, is probably all the other pieces that enhance the love that I have for the industry and everything else. So I needed all those things, but I look back and say, boy, I would have pushed all my focus here and really gotten on board even earlier than what I did in the industry. And I've been in the industry over 35 years. So I've been in it for quite a while. And I was, again, very fortunate that my path went this way. It's not anything I ever would have done on my own. And things were just in place to make that happen. So I'm very grateful. Mm-hmm. If we look out into the future, again, because I have such a passion for the industry, I think that a big piece of what I would call success on my end in the industry would be to start to shift the industry back towards its roots, back towards its core being, which was not just the money side of it, but really helping individuals, helping families, creating wealth out into the future for legacies, for charity, for all kinds of pieces and parts. And that's what I want, is to impact that in a big way, to get advisors committed to the truth, committed to really helping this country get back on its feet.
I love that. Thank you very much. So I don't know that I have anything more wise or anything to say than what's been said. So we're going to, tell everyone that we'll put Truth Concepts in the website in the bottom in case they don't know what it is. So it's a simple link to get through to Todd and his organization. And even if you wanted to use the calculators for a little while, I think there's some videos too, right? Just kind of explains how to use some of them. There's that website has got all kinds of information. I mean, it's something that everybody should. Say that again.
Yeah, I said, go to truthconcepts.com, dig through it, enjoy. There's lots of articles and pieces and parts, and just have fun learning.
Good. Well, thank you very much, and we'll see everyone next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.